Good day. It's Matt Carbray, Ridgeline Financial Partners. This is Matt on Money. Amazing to think that here we are, September 30th. Tomorrow will be October 1st, and we're going to be entering into the fourth quarter, which gives us a real limited amount of time to think about some of the strategies that may make some sense for us as we approach the end of the year. And to top it all off, there is some tax legislation that's out there in Congress that very much so could change the tax environment that we all have to deal with individually. So, a lot to come on today's episode of Matt on Money as we talk about tax changes and strategies for the end of the year 2021. Okay, when we talk about some of the things that you can be doing personally, I will just talk about my own situation. Well, with three young kids and future educations to fund, being a resident of the state of Connecticut, the state of Connecticut, through its CHET program, Connecticut Higher Education Trust, which is a Section 529 sponsored program, gives me and my spouse a tax benefit for setting aside monies for our kids' future education. In the state of Connecticut, that limit is $5,000 for a single tax filer and $10,000 for a family. That is a household limit. It is not a per beneficiary or per child limit. But if you find yourself in a 6% state of Connecticut income tax bracket and you put $10,000 away for those future educational expenses, you're saving $600 for doing so. I think we all value, to different degrees, education, but I think we all would be in agreement that the costs associated with an education show no signs of letting up. So the state of Connecticut's program for those that are in Connecticut may be a great vehicle to use for those future college educational expenses. So keep that in mind as it pertains to saving for college education. As we think about saving for retirement, the retirement limits have not changed, unfortunately. We hope that they do with the new legislation that's out there. But you can put $6,000 into an IRA. You can put $7,000 in if you're over the age of 50. That is subject to certain income limitations, and there are different types of IRAs. So it's very important that you do consult with a financial professional as well as a tax advisor to figure out what you can and cannot do. But we've also got a couple of months left in the year to think about maximizing your retirement plan. If you've been fortunate enough where you've built up a lot of emergency reserves and savings, maybe thinking about increasing what's taken out of your pay between now and the end of the year to get more money into your retirement plan may be a great idea. If you are a participant in a 401k, a 403b, a 457, they all kind of operate fairly similarly in that it's a $19,500 limit for yourself. And if you're over 50, it's $26,000. So take a look at where you're at year to date. Know what those limits are and possibly increase your contribution over the next couple of months, and it may make a pretty substantial difference over the long term for your retirement savings. Okay, when we think about where this tax legislation may end up, it's so hard to say, but I am of the opinion, this is again just my opinion, and I think a lot of people would agree with me, that the tax rates that we have right now are going to be going up. Now, it's a matter of who it's going to go up for. Is it going to go up across the board? Everything that we have been hearing, and this goes back to the presidential election, was that 400,000, 450,000 were the targets for those individuals that were likely to be paying higher taxes on earned income, on capital gain activity. We're also likely to experience lower lifetime gifting exemptions. Right now, we have very lofty gifting exemptions that are almost $12 million. I believe it's $11.7 million per person. That could be halved. It could even be lower than that. Not exactly sure how that's all going to be playing out. But what you have to kind of visualize and think about between now and the end of the year is if you take certain actions, if you decide to sell certain assets, does it make sense for you to do that in this tax year? Or does it make sense for you to do it in the following tax year? We've got, again, a short window here. Even though tax returns aren't due up until the tax filing deadline, which is April 15th, a lot of the decisions that we make between now and the next couple of months is going to have an impact on that. So it's no better time than the present to just reassess your situation, see how your year is shaping up. You almost have to have a little bit of foresight into what next year is going to look like, and that should be able to help you in making decisions. The conversations that we're having a lot with clients right now is surrounding selling assets that have appreciated, paying the tax now versus paying it in the future, selling investment real estate, exercising stock options. So if any of those are relevant to you, please feel free to reach out to us. We love to work closely with your other financial advisors so that we're all on the same page. We're all making decisions that are in your best interest. So thanks so much for tuning in. This has been Matt on Money, fourth quarter edition. Hope you have a great end to the year.